said mutual funds and exchange traded funds is what you usually use. So,
Yep.
what's the difference between them and why do you buy both?
Okay. Sure. Good question. And so, in a sense, there's not much difference between them. So they're both baskets of stocks or bonds or both. Where you investors pool money and a manager buys the stocks or bonds or both according to the mandate of the company. So it could be a large cap growth fund or a large cap growth ETF, they could have um, the same types of investments. They could hold the same investments. They could have the same purpose. The difference is in like their legal structure. And so when you buy or sell a mutual fund, an open-end mutual fund, there used to be closed-end mutual funds. I don't know if there are anymore, but if you buy an open-end mutual fund, you buy it directly from the fund company. So if you go to buy a Vanguard fund or Fidelity fund, you are buying that from Vanguard or Fidelity. You buy it at any time when the market is open. The trade settles at the closing price of the market, and then so if you were to log on now and buy $1,000 of the Fidelity S&P 500 fund, you would put the money in. You'd see tonight, you see that trade closed after the market, and you got it for whatever the closing price was, and then you own those shares. An exchange traded fund is a little different in that you will buy or sell that from another investor on the market, and it happens right away at whatever the market price is. And so say you wanted to buy the Fidelity S&P 500 ETF, and you went on right now and bought that, you would own that in about 10 seconds. It happens pretty quick. And you would pay whatever the price is now, and you would be buying it from whoever you sold it to. That will take 2 days to settle, and mutual funds only take 1 day. But that's really the main big distinction. And then there's one other difference is in the structure. Exchange traded funds can do they are more tax efficient because of the way that they're structured. The issuer does not have to distribute all the capital gains that a mutual fund issuer would have to distribute. One other thing is, so we buy stuff at the Schwab or at TD Ameritrade. We have to pay like $24 to buy a mutual fund at Schwab, and $9.99 to buy a mutual fund at TD Ameritrade, but nothing for ETFs. So they trade like stocks where there's no cost. Doesn't mean that Schwab and TD Ameritrade don't make money from that, because they get payment for order flow. That's a whole separate issue. Could be a whole podcast in itself.
Why don't you use all ETFs?
So we don't use all ETFs because they're newer, right? The oldest ETF is now 30. And so there are some huge ones, but a lot of them have been formed in the last few years. And we like to see a fund out in the market for 3 years before we invest in it. And one other thing is that, we have mutual funds in a lot of places in taxable accounts where people have unrealized gains. And so if we were to just swap out that mutual fund for the ETF for the supposed tax benefits, we would have people incur a huge tax liability in selling. And so what we're doing is we're slowly introducing in retirement accounts, we could just bring them in. But in taxable accounts, what we have to do is when we're doing a rebalancing trade, if we're selling from the mutual fund, because it gets to be higher than it should be, we don't sell out the whole thing. We sell the incremental part that is too much. We'll sell from the mutual fund. But then if it gets to be too low as a percentage of allocation and we needed to buy it, then what we will do then is buy the ETF. So in a lot of accounts now, people will have both the mutual fund and the ETF. If for large cap core or small cap value or whatever it is. if they have taxable accounts. And so I would prefer not to have two of all those different asset classes. But the reality is, if we could save a little tax money, why not, right? We should do it. If it makes the portfolio a little bit more efficient tax wise, and that tax goes right to the client and the investor, then we should do it. And if it makes it, unfortunately, it makes the statement look a little sloppier, having, 15 holdings instead of 10 or 12. Yeah, well, if it saves $5,000 a year or $3,000 a year, well, then it's worth it. I'd rather have 3 extra lines on the statement. Does that make sense?
Absolutely. So when it comes to deciding if you're going to do, mutual funds or ETFs, is that something the client decides, or is that something you suggest to them?
Well, that's something that we decide. So we
Okay.
will have a portfolio allocation for somebody, and it'll be based on the funds that we're buying at the time. And so when we start the relationship with clients, we figure out, we say, hey, we think this asset allocation for you should be, let's say, 65% stock funds and 35% bond funds. We talk to the client to make sure they're aware of like what the expectations are for that portfolio, the risk and return expectations. And then, once we agree, the client and we sign an investment policy statement. And the investment policy statement, will say that we're going to have those allocations. They might deviate up to 20% on those, because we're not going to be buying and selling every day to keep it exactly 65-35. And then that portfolio statement, investment policy statement, will also specify some other things, like we're not going to short, we're not going to use margin, we're not going to buy venture capital or hedge funds or private equity. Like, we're not going to just go, the client give us discretion, right, to go buy what we think makes sense for them. But we want to let people know at the outset that we think there are a lot of things that really don't make sense in most cases. And so we're just not going to use them. And so that's all in that investment policy statement. It's a short document, it's only 2 pages, but it really specifies that, we're going to be buying mutual funds and exchange traded funds. And that's it. Maybe we'll buy a T-bill or something, or a CD or something there and here and again, but really it's the bread and butter is mutual funds and exchange traded funds.